Hello students and welcome back. Today I will be taking you through the last topic of this course. And in this topic, I'm going to discuss what happens in the case of events and how does an analyst analyze the companies which are into mergers and leveraged buyouts from the perspective of credit. Let's move on to understanding the topics that will be covered in today's lecture. First, we'll talk about what are mergers and acquisitions. Then we will talk about what are the various ways of valuing an acquisition target. We will also see how future performance is projected. Then we will discuss the agenda of the analyst. How does the analyst go about analyzing a merger or an acquisition? I will explain the actions of the analyst to you through a case study, which will help you understand the analysis better. In this process, we will also discuss the key ratios that are used for credit analysis in the case of mergers and acquisitions. And finally, we will talk about leveraged buyouts and what makes these leveraged buyouts different from mergers and acquisitions. Before we start, there is one thing that I must warn you about, and that is all mergers and acquisitions are different because no two companies are exactly the same. However, the principles that you follow in the credit analysis of the company acquiring a target will remain the same. So it is very important for you to conceptually understand what we are doing here and why we are doing it. An enterprise has two ways in which it can grow. One is through internal expansion and the other is through external expansion. If a company grows through internal expansion, it means that it is growing in the usual course of business. It may be expanding its product lines, it may be doing some new research or development, or just replacing old technology with the latest one, and thereby increasing its market share. Now, this type of growth is what is called organic growth. Organic growth usually takes time. Companies can also grow overnight, and that is done through acquiring another company. It could be a peer in the same industry, or it could be a totally different company in another industry, which will help the acquiring company extend its lines of business. Now, such growth is called inorganic growth. And inorganic growth is usually done either through mergers, acquisitions, buyouts, takeovers, and the like. And they are becoming more and more common these days. And that is what makes it important for you to understand how to analyze such a situation. In this lecture, I will only be talking about inorganic growth and mergers and acquisitions. The company that is buying a company will be called an acquirer, and the company which is being bought will be called the target company. Then I will be using words like consolidated or combined, which will show the state of the company once it has acquired the target. Now let's move on to see how one can calculate the value of an acquisition target. One of the most common methods used to ascertain the price of a target is DCF or discounted cash flows. Discounted cash flows calculate the present value of the expected future cash flows that the target company may generate in the future. The next way is to calculate the market value of the traded equity. This can be done for companies that are publicly traded, where you can see the currently traded value of one share and multiply it by the shares that are there in the company, and thereby getting the market value of the equity shares of the company, which will become the value of the acquisition target. Another method, though conservative, is the book value method. Book value method is a backward-looking method. It looks at the book value of any tangible assets that are there on the balance sheet. It completely ignores any intangible assets. And why I say that it is a backward-looking method is that it looks only at the values which are recorded in the balance sheet and does not look at what would be the currently traded prices of those assets. Another method is the liquidation value. Now, liquidation value is the value that can be generated if the entire target enterprise can be sold off either as a whole or in parts. And the value thus generated is called the valuation method. Again, this is not a practical value. It is just an assumption that how much will the separate assets of the company fetch if they are sold in the market today, or if the entire enterprise as a whole is sold to a third party, then how much will it fetch? So it also involves a lot of assumptions. Another method that can be used to value the targets is replacement method. Replacement value is the value of investment that will be required today to recreate an entire enterprise exactly as the one which is our target. We will not go into the valuation of the acquisition target any further than this because that is a different course of study altogether. Here our focus is the credit analysis of the acquiring company to see how the operations look once it has acquired the target. When an acquiring company has decided to acquire a target or is in the process of deciding whether or not it should acquire the target, then it is very important for it to project the future performance of not just the target, but the target and the acquirer as a combined entity. So this is really the job that an analyst has to do. An analyst must be able to project how the combined company will look once the acquisition is complete. The analyst, in order to analyze an acquirer or a combined entity once the acquisition is complete, must understand what was the initial thought process of the acquirer when he went in for this acquisition. Whether it was entering a new line of business, whether it was to capture a bigger market share, whether it was to take advantages of economies of scale. So it is very important for an analyst to understand the perspective of the acquirer before he begins his analysis. The analyst must also find out what are the acquirer's projected sales and costs. It is possible that the acquirer does have a good company that he is operating right now. However, he is not able to organically increase or expand his business, and that is one of the reasons why he is looking at inorganic growth. So if that is the point, then how successful will the acquisition be? Or is it that the acquirer has got a very good plan for expansion? In fact, they have been growing internally over a long period of time. However, a sudden opportunity to seize the market has arisen, and the acquirer feels that inorganic growth is probably the best way to capture the market, and he has a good target in sight. So it is very important to understand the perspective of the acquirer and also to vet it by your own analysis to strengthen the assumptions in your analysis. The analyst also needs to look at the impact of the acquisition on the acquirer's financials. Now, this can happen in a lot of different ways. The acquisition always has to be funded. How will it be funded? Is the acquirer thinking of issuing more shares to fund the acquisition, or is he thinking of raising debt? We know that raising debt can make the company more leveraged and hence weaken its credibility in the credit market. However, issuing shares is also not an easy decision because in that way they are diluting the existing equity shareholders' interests. In addition to this, the acquirer also takes over the debt of the target company, which also severely impacts their debt and credit position. And finally, there may be certain temporary financial outflows which the analyst must look at in order to make sure that he has accounted for each of these financial aspects and make his analysis as accurate as possible. The target company also, before it became the target and got acquired, must be having its own plans of organic expansion or increasing their sales or revenues, and those are the things that the analyst needs to look at. It is possible that the target company in itself, once absorbed in the acquiring company, will support the increase in revenue or sales. Lastly, the analyst needs to find out the impact of all this restructuring, acquisition, taking over of debt, issue of more debt or issue of new share capital on the financial structure, on the capital structure of the acquiring company. It is seen that large acquisition impact the capital structure of the acquiring company in a massive way. So this is also an aspect which the analyst must look at from credit perspective. So let's see what will be the analyst's agenda and what is the step-by-step procedure that the analyst will follow in order to analyze an acquiring company. The first step for the analyst to do is to take the balance sheets and the income statement of both the acquiring company and the target company and prepare a base case. The base case will be made on the assumptions of the acquiring company. What the acquiring company is thinking will be the sales or the revenues or the capital structure in the future. And then the analyst must test the assumptions that have gone into building this model, into building the projections made by the acquiring company. The analyst must also look at the impact of various different scenarios on the combined company. It is possible that the projections of the acquiring company may be too aggressive, or suddenly the market conditions may change. So what if not everything goes as planned? How will the new balance sheet of the acquiring company look like? So these are the scenarios that the analyst must test. In his scenarios, the analyst must also look at the impact of financing cost. How was the acquisition financed? Whether it was equity or it was debt. In my case study, I would like to take the most extreme scenario, and that is the entire funding of the acquisition being done by debt, because that will make it really risky and also much more interesting. And that is what I call taking a bearish approach. So an acquiring company is always very positive about the target that it is going to acquire. And this is the reason why it is taking so many pains. However, as an analyst, it is your responsibility to take a cold look in this positive environment and also see how will things shape up if there was a downside to this acquisition. I will end this lecture here today, and in the next session, I will continue with the various scenarios of mergers and acquisition, and we will see how the analyst practically analyzes the balance sheet of the acquiring company. Thank you very much. Looking forward to seeing you in the next session.